you all for joining us during this, joining me during this session on the Ethical Finance ASEAN 2023. And this section focusing on financing a transition to net zero. So for the next 15 minutes or so, I will talk to you on building and the challenge and opportunities in developing sustainable finance in Southeast Asia. This talk is based on a report that we launched last year. It was a joint report by the World Bank and the Beijing Institute of Finance and Sustainability. And the report is entitled Unleashing Sustainable Finance in Southeast Asia. In case you're interested, just Google it and then you can easily find it. So I have a few slides to share with me, with you today, and bear with me. I will present some statistics and some numbers characterizing the state of development of sustainable finance in Southeast Asia, and then discuss some of the challenges in further developing it. So let me start with my first slide. And here I would like to emphasize that the financial sector, and I think this should come as no surprise to you, that the financial sector can play a critical role in supporting the transition to net zero. And as you can see on this framework in the slide, for the financial sector to support sustainability in finance, it needs to address two interrelated challenges: the managing of risks, of physical and transition risks, as well as the opportunities, what we refer to the opportunity side, which is the goal of catalyzing private capital and effectively allocated to sustainable investment. And these two are highly related and one can reinforce the other. So when thinking of policy options, policy goals to support sustainability in finance, policymakers need to think of a holistic approach to the agenda, to the policy agenda, thinking on both the opportunities and the risks and how they may interact with each other. And another important point to make up front is the idea of policy coherence and coordination across the various policymakers. It's important to think that while one set of policies may be fostering, say, investments in sustainable investments, you need to make sure that incentives from other policies may not be undoing this. So there's a need for coherence and coordination. So for the next 10 minutes or so, I am going to put the spotlight on the opportunity side, on this big bucket on the left in the framework. And I will focus and I'll zoom in the financial sector, that's the yellow bubble. And I will look at the financial sector for five ASEAN countries: Malaysia, Indonesia, Philippines, Thailand, and Vietnam. In the next slide, what you can see is that there has been impressive growth in sustainable finance, but there is a large untapped potential. For example, when you look at the amount outstanding in sustainable debt in the ASEAN 5 countries, they went from virtually nothing in 2015 to more than $20 billion by the end of 2021. That's a huge growth within those 6 years. However, when you put these amounts in perspective in comparison to the overall amount outstanding of conventional debt markets, they are tiny. They represent 2.5% of conventional debt markets. On the graph on the right, you can see those are the tiny blue bars at the bottom at the last 3 bars. So sustainable debt markets are still very tiny. Private equity markets are even smaller when you think about financing volumes. They represented in 2021, 5% of sustainable debt. So there's huge untapped potential for these markets. The potential for growth, it's impressive. And even so, when you compare some of these ASEAN countries with more developed countries in terms of the depth of sustainable debt markets. For instance, in the next slide, you can see a cross-country comparison of the depth of sustainable debt markets, and you can see that Malaysia has only the 36th deepest market across 76 economies with sustainable debt issuances. So Malaysia will be that first yellow bar in the graph. So in terms of GDP, the amount of standing of sustainable bonds, for instance, and syndicated loans was roughly around 1% of GDP in 2021. Whereas at the top, or the deeper and more developed markets, you have, for instance, France and Netherlands with sustainable debt representing more than 10% of GDP. So again, the potential for growth, the untapped potential is huge. However, sustainable finance, it still has a very limited reach in the ASEAN 5 countries. And you can see that in the next slide. In slide 4 of the presentation, what you see is that across firms, since 2017 to 2021, that's basically when these markets developed, what you had is less than 100 firms, non-financial firms, have issued sustainable debt across the ASEAN 5. And again, a reminder that the ASEAN 5 is Malaysia, Indonesia, Philippines, Thailand, and Vietnam. Private equity markets, they're smaller in volumes, as I highlighted before, but they have greater reach. A greater number of firms have issued in these markets than in sustainable debt markets. But again, the volumes are tiny. And what we noticed in the report is that there's a sizable gaps for SMEs. Most of these issuances are from listed companies, so typically the larger firms in an economy. But there's also limited reach across projects. Green debt accounts for the bulk of the financing volumes. So it's still the volume of financing still geared towards mitigation efforts, towards greener, more projects. There's also limited variety or limited range of sectors being financed in sustainable financial markets in the ASEAN 5. And what you see is a great concentration in the energy sector. You can see from the pie charts that Malaysia and Philippines, roughly half of those issuances are tightly linked to the energy sector. In the case of Malaysia, there's a sizable amount of funding went to buildings. That's the Merdeka 118 building. In the Philippines, you have a little bit more on the water, use of water, but overall, it's a very limited range of products, especially when you compare to more developed countries. And here in the slide, I have the case of Japan, just to showcase one example. But when you look across the board at more developed markets, they are typically characterized by a wide range of sectors being financed through sustainable financial markets. Not only energy, not only buildings, but also more efficient and greener transport, more efficient and better use of water, waste management, land use, among others. And you can see that in the case of Japan, energy accounts for less than roughly 25% of those issues, much less than in the case of Malaysia and the Philippines. In the next slide, in this report, we also go into the financial sector challenge, the perceptions of challenge in the marketplace. What is preventing the scaling up of sustainable financing? So to answer these questions, we conducted a survey among financial institutions in the ASEAN 4, and in this case, it's Malaysia, Indonesia, Philippines, and Thailand. We had over 100 financial institutions, ranging from banks, insurance companies, and funds, and some frontier countries being China, Korea, Hong Kong, Singapore, and some European countries. And what the key findings from the survey is that there are three main challenges in the marketplace. One is there are gaps in climate-related information. Data availability, there's very limited data in terms of climate, and the complexity of climate-related information that limits the ability of financial institutions to handle and process that information. Data quality is also an issue, as reflected by a lack of reporting standards, making it harder for financial institutions to compare different projects, different firms. There's also a perception of limited capabilities, not only for financial institutions, but also for policymakers and for firms themselves. So combining these gaps in information and the limited capabilities, what we have is that financial institutions end up adopting screening methods. Think of negative screening to integrate sustainability into the investment decisions. They still don't have a more holistic view in terms of incorporating sustainability into their portfolios, into risk management and all. It's still mostly done through screening, identifying a riskier sector and then screening those sectors from their portfolios. And a third key finding was the perception among financial institutions that there are limited investment opportunities. This can be arguably driven by a limited pipeline of projects, highlighting that there are challenges from the private sector, from firms themselves in developing and putting into place, in making investments into sustainability. There's also, as I mentioned, the issue of lack of capabilities in the private sector that could also partly explain this lack of projects. And again, this suggests the idea that I highlighted up front, the need to have a coherent, holistic approach when thinking about financing a transition to net zero, that you need to think of financial sector challenge, but also the challenge to the private sector in developing these investments, in making these investments in sustainability. In the next slide, what I will talk a little bit about regulations, and what we show in the report is that regulations do matter. And what we have here, it's in the slide, we have a scatter plot that shows that countries with more developed sustainable financial markets usually tend to have more developed enabling policy frameworks. And here I'm showcasing, for instance, the information environment that captures taxonomy development and this reporting and disclosure standards, for example. And specifically, taxonomy adoption has a significant impact on capital raising activity through sustainable debt markets, for instance. But implementation is critical. In the ASEAN 5 countries, the building blocks for this enabling environment for sustainable finance, they are in place, but effective implementation is still incipient. Taxonomies are still being adapted. Reporting and disclosure standards are still in the process of being implemented, just to name a few. And one last fact that emerged from the survey again is the idea that the mandate from board and the top management of financial institutions matter. In fact, the surveyed financial institutions mentioned that as a top driver for their sustainable investments and activity in this segment. However, a clear reference to sustainability in financial institutions' long-term strategies is not yet widespread. What we see is that less than 50% of the surveyed financial institutions had such a clear reference. So a key takeaway is that there is a strong need, a need for strong actions by the top echelon of financial institutions and governments, and that regulations do matter, but effective implementation is critical. And in my last slide, and apologies if I'm running behind schedule, and here is I'm going to leave you with what we call the REACT framework. It's a set of 5 areas for policy action to mobilize private capital to sustainability, to finance the transition to net zero. First, readiness is addressing the high riskness of investment in sustainability. Most of these investments may have an uncertain time horizon, uncertain returns. So there is a need to de-risk and foster risk diversification. The second area of scope for policy action is the enabling environment. And here it's more general. It's about financial market development and more broadly. I mean, sustainable finance is not going to emerge out of the blue in a bubble. It's part of the financial sector. It's part of the financial system. So you need that enabling environment in place. And one specific area is the idea of financial market infrastructure. They need to have well-developed infrastructure. The third bucket for policy action is analytics, is the idea of closing data gaps and empowering the various parties to use data effectively. And here, effective implementation of taxonomies and disclosure and reporting standards is a key. It's our key recommendations, our key policy actions. The fourth one is capabilities. It's building capabilities and enhancing what we call, or what we refer to, sustainable finance literacy. It's a broad-based efforts across financial institutions, policymakers, and the private sector at large, as well as think of cross-country knowledge sharing and collaboration in international forums. And for instance, the COP28, as I'm sure our next speaker will talk about. And the last area, broad area for policy action is the idea of transition. It's mitigating the impact on vulnerable segments, ensuring a just transition. And who are these vulnerable segments? They could be those that may be negatively impacted by a transition towards greater sustainability. Segments that face greater risk of exclusion from sustainable financial markets, be it because of opacity of information or riskiness, and segments that may face greater climate risks. And I'll end now with the REACT framework. Thank you very much for bearing with me for this 15 minutes. And Omar, I hand back to you. Thank you very much.